Governments always say the same thing. We are working for you. Financial freedom, stability, growth, opportunities. But if you look a little closer, the picture is far from bright. Throughout history, governments have played secret financial games to make you and me poorer while accumulating wealth and power for themselves. And the most surprising part, these games are not new. They just come in new packaging with new names. But the purpose is always the same: to move wealth upwards and make people dependent on poverty. Let's start with the simplest but most sneaky: inflation. When a government spends more than it collects in taxes, it has two choices: be honest and impose new taxes, which is political suicide, or quietly reduce the value of money. This means the money in your pocket is the same, but you can buy less with it. It's a silent tax. This game was already played in ancient Rome. In the 200s, emperors reduced the amount of silver in coins to fund military expenses. Coins that were once pure silver eventually became almost entirely copper. You had the same coins in your pocket, but the value was gone. Prices rose, wages didn't keep up, and people quietly became poorer. The empire won, the people lost. During the Middle Ages, the game changed slightly. Forced loans. England, France, Spain, kings demanded money from the rich under the name of loans. But it was not voluntary. Refuse, and you lost your property. Sometimes repayment was promised, but late or in worthless money. Kings funded their wars, and merchants lost their capital, all justified under the word patriotism. Then, in 1694, the Bank of England was founded, but not for the people, for the state's war debts. Rich investors bought bonds, and the government guaranteed interest payments. And who paid these interests? The people's taxes on salt, beer, and cloth. The rich got richer, and the people footed the bill. The system looked like this, and it hasn't changed. In modern times, the tricks are the same, just with new names: budget deficits, bonds, bailouts. Politicians say investment for the people. But where does the money really go? To defense companies, big banks, and giant corporations. And who pays the price? Of course, the people. Remember the 2008 financial crisis? Banks crashed, and governments bailed them out with rescue packages. Profits went to the banks, losses to the people. They called it saving the system. But in reality, it was the system that crushed the people. Pension systems are just another version of the same game. People thought the state was saving their money, but in many countries, it was already spent. All that remained was a piece of paper. We'll pay later. Today's retirees are funded by tomorrow's taxpayers, a kind of generational Ponzi scheme. And when it collapses, they say reform, but reform usually means lower pensions, later retirement. It's all about perception. Inflation is called growth. Forced loans are called duty. National debt is called investment. Bailouts are called stability. Pension cuts are called reform. But at the core, it's always the same story. Wealth goes up, burden goes down. This game has always worked because people rarely know the history of economics, don't understand the system, don't see the trap. After 2008, a new term appeared: quantitative easing. Sounds sophisticated, right? But it just meant central banks printed unlimited money, bought bonds, and inflated the market. The result? Asset prices rose. The rich got richer. The middle class, crushed by rent, prices, and low purchasing power. And finally, the hidden taxes. Without raising income tax, they take your money through VAT, fuel, and inflation. If prices rise faster than wages, the government wins. This is not a flaw in the system. This is the system itself. And don't forget, the game is still going on. Only the decor has changed, the names have been replaced, but the stage is the same.
I was standing, staying still, never said what I feel, and every time I took the blame, carried all this quiet shame.